Hello and welcome to The Global View, the show where we look at ways for investors to make money beyond the ASX listed universe. I'm your host, Juliet Sarli. Let's look at our top tweet of the day, or X as it's called now. It's all about oil. Lance Roberts, who is a guest often on ausbiz, saying oil is extremely overbought. Previous episodes have consistently led to rather sharp corrections. So he is looking there at potential drops potentially as we continue to see others call for that $100 a barrel oil. On the macro front though, data showed the US economy did maintain a fairly solid pace of growth in the second quarter. Second quarter GDP came unrevised at 2.1%. Inflation meanwhile slowed in the second quarter. Growth for the first quarter was raised to a 2.2% rate from the previously reported 2% pace. And the number of Americans filing new claims for unemployment benefits rose slightly last week. We saw US Treasury yields pull back from their recent 16-year highs. That added to some investor respite. The dollar also pulled back, but dollar yen still close to testing that 150 level. Well, interest rates have caught the market a bit offside, and my next guest says the market may still be underestimating the potential of rates on the long end to move yet higher. For more on his take, Tim Mulholland from TJM Limited joins me now. What are we underestimating here, Tim?
Well, everyone thinks, well, we all obviously know the Fed is not loosening its grip on short rates. So, there's a gravitational pull towards the funds rate, number one. But everybody talks about that long rates are a function of economic weakness, which is just around the corner. So you see some people calling for duration and whatnot. But what everyone's forgetting is that we have twin deficits. You have to go back to the mid 80s, I guess, the last time this was a conversation. And that's when you run a current account deficit and you run a trade deficit, of which both are large for the United States, which does not have the savings and has to borrow abroad. So that, I think, will result in a increased risk term premium for especially longer dated maturities. And I think that's something that the Fed is not, and that the Fed knows that, but the market is not, because there's a supply situation when you have that as well. So our Treasury supply, if you've noticed, is getting huge. So at some point, and this is a good chart that you're showing right now, this shows the federal government receipts, or the income from taxes. It's plumbing a lows that we saw the last seen at the financial crisis, and we're not even in a recession yet. So receipts are going down, expenditures are going through the roof. That would mean you're getting wider deficits. So I think that the deficits, if you take, there might be a chart showing that as well. We have the current account and we have the federal budget deficit, which is running around 6% of GDP, by the way. 6% of GDP is a very big number. So I think and we're not even counting inflation. Inflation, say, at 3%. This one chart I think you're showing right now shows the budget. It's a little bit of a surplus because coming off the COVID, but this is going to be updated. I think this is going on a yearly basis. So you're going to see this close to 7% of GDP, but the trend is downward. And that means the budget deficit's getting larger. And that goes with the fiscal spending that is, currently right now, there's this big, spending limit budget that they're stalemate in Congress right now. But it will get resolved and the budget deficit will grow and the funding will increase. So that tells me, looking at Treasury yields, especially on a super long-term chart on Treasury yields, you broke a downtrend line, which we talked about. I don't know, I've probably been chirping about this for the past 8 months or so, maybe even a year. But you've broken in this Treasury, long-term Treasury. You can see where we were at the peak in the 1980, 81. That's actually when I came into the futures business. So I remember those rates very well. But you broke that long downtrend line. Given the dynamics that I just mentioned, notwithstanding inflation, nothing else, just a sheer supply here that you're seeing. And I think you can make a case for 5.5% to 6% 10-year yields. And that's still 1% to 1.5% from where we are right now. And how will the market handle that? That's going to be a big question, and I don't think the market's prepared for that.
All right, Tim, so you're talking there about some of the risks and the worry too about what is happening in the private market. Just tell us about how much of the loan market, with this unhedged point, even before we see interest rate spikes, how much of a concern that is.
Yeah, and these are private markets, so you don't see as much, obviously, because they're private markets, but there's been huge flow. In fact, the lending in the private market lending is maybe 65% of total lending. in the market. And this chart is an interesting one right now. The unhedged amount. So all the private equity deals that get done, the private credit deals that get done, and these are floating rate loans. So companies that are taking these loans, they didn't hedge the floating rate risk. Well, if you have a floating rate loan at 0%, and now rates are 5.5%, 6%. Actually, in these markets, they're probably close to 8 to 10%. And they're coming for refinancing. That's a big hit to cash flow. And that to me could spell a lot of trouble here for the private sector. And you might not hear because it's not regulated. And I guess if that market, which is huge, I mean, $1.5 trillion in private credit, and we all know private equity, how huge that is. But if those markets were to ever capitulate or we'd have a real crisis, I don't think they'd get a bailout. So that's a big unknown in the marketplace. And I think it's a big area of concern because we're looking for this credit event. And you're not seeing it in banks, and I don't think you'll see it in banks outside of their treasury holdings that they have to mark down. But the lending has taken place. The real lending of the floating rate nature is reflected in the private markets. And the other thing, the interest rate, just to highlight that point, the interest rate coverage went from in 2020, January 22, it was 23%. So companies, their interest rate coverage was 23%. That's very manageable. Today, that number is 62%. That's triple the interest coverage. So that tells you right there that there's going to be a little hurt, I think, in this private sector of the economy, which is monstrous. The private lending market, but almost $2 trillion.
Tim, let's take it back then to the equity market, and particularly what we're seeing on the S&P 500. Looking a little heavy, you say could test that 4,000 level.
Yeah, this is a nice little chart here, going back quite a ways, but at least to where we started from the pandemic. But as you can see, we pretty much doubled from that level now, and we've obviously very strong. And if you take a look at this chart, I think it's kind of showing you right now that you're topping out. And you look like there's a trend line, if I were to connect those lows, would be around 4,000. So I think that's probably minimum. If we get below 4,000, and given the other dynamics and a shock in long-term interest rates, that repricing in this market could, take you to what people have given up on. We could go revisit last year's lows.
Okay, so getting that back to the investment thesis, you're bearish on both stocks and long bonds. So no to the 60-40 portfolio.
Yeah, absolutely. I mean, 60-40 was a disaster last year. Everybody thought, okay, it was 1 year off. It looks like it can be even worse this year. But what I do like is I think in the front end of the market, and 2-year ladders, like treasury ladders is what I view, is something that I think still makes a lot of sense. And some, value stocks that I think are priced well, don't have a lot of debt, especially the floating rate debt. And if they do have it, they're hedged. And I think those companies there's some out there as well, but they're the value type that, nobody's really paid much attention to, given the dominance of the Magnificent Seven in the S&P 500. So I think it warrants caution here, and I think this fall can get a little bit rougher for us.
All right, Tim, thanks so much for your insights and for joining us on AusBiz. Tim Mulholland from TJM Limited. Before we go, let's get a quick check of how we are expecting to open in around 2 minutes' time. And we are expecting a positive session for the final day of the week, the month, the quarter. We had a good rally coming through, or some higher moves, I should say, on global markets. And the SPY futures is suggesting we'll rise by 0.6%. Let's see if that occurs. Danny is up next with the open.